Ladies and gentlemen, thanks for coming tonight. My name is Rob. I organize Idea to IPO. We've been doing events in Silicon Valley for many years. We hold events multiple times a week from San Jose to San Francisco. We always have a busy calendar of events. I'd like to highlight a few events that are coming up. February 6th, how to successfully pitch to investors and get funded. Angel investor Gary Jinks. That'll be a lunchtime event, which we haven't done in a long time. That's going to be in San Jose. In collaboration with Startup Grind Global Conference 2020, we're offering a 15% discount. That's going to be February 11th and 12th in Redwood City. And we have our own Silicon Valley half-day AI conference, and that's going to be in Santa Clara on February 13th. So check out the details for those events and all of our events on our website, ideatoipo.com. What'd you do with the cake? Anyway. We launched officially on February 1st, 2010. By the way, it's 2020. Anyway, so at that time, we had no members and no events on our calendar. At this stage, we have over 70,000 members among all our meetup groups in the Bay Area. We've organized, promoted, and produced over 2,157 events. By any standard, by any measure, we're the most active, most prolific startup event organization in the history of Silicon Valley, bar none. But since this is such a milestone, I was expecting a better reaction than that. So let me expand on that. So if we're the most active, most prolific startup event organization in the history of Silicon Valley, and Silicon Valley is the global center of entrepreneurship and innovation, that would make us.
Give a big round of applause.
I wasn't done, but let me finish what I was going to say first, okay? So that would make us the most active, most prolific startup event organization in the history of the world. Now. Yeah, so that explains the cake and the number 10, and we'll feast on that later. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. To that end, we provide content that's practical, actionable, and relevant. Stuff you can actually use to succeed as entrepreneurs. We believe in building community because Silicon Valley is an aspirational ecosystem. It attracts people from all over the world who come here to do great things. Who here is not originally from Silicon Valley or the greater San Francisco Bay Area? Cool. So who here was born and raised in Silicon Valley or the San Francisco Bay Area? 4, 3. Let's hear it for the natives. So I want to welcome you guys to Silicon Valley. So by the way, in addition to our content-oriented events throughout the week, we also have some fun social events, and we have a TGIF mixer on a regular basis at the Hyatt Regency Santa Clara. It happens to be one tomorrow, January 31st, and that's hosted by Colby Lepore, one of our team members. So check that out tomorrow. You're all invited. With regard to value, it is important that we provide value at each and every one of our events. So we make sure our events are affordable because we know many entrepreneurs are struggling financially. And if you cannot afford the cover charge for whatever reason, come talk to me and we can work something out. And at each and every one of our events, we make sure that we provide a delicious meal. Was that a delicious meal? Yeah. Well, let's hear it for Wilmer Hale for sponsoring that delicious meal. More importantly, though, at each and every one of our events, we want to make sure that we provide value for your time, which is your most valuable resource. Is anyone here getting any younger, besides the folks on the panel? So when you invest your valuable time to come to our events, we want to make sure that you maximize your ROI. So we have many partners that help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, co-working spaces, colleges, universities, lots of other players in the Silicon Valley startup ecosystem. So once again, we're grateful to Wilmer Hale for hosting us at this beautiful venue. Is this a beautiful venue? And providing us with an awesome moderator, as you will soon see. So let's hear it once again for Wilmer Hale. A few of our other partners are here tonight. I would like to have them come up and say a few words. Let's hear it for Jen in Realty School 101. Applause.
Good evening, everyone. Thanks for coming out this evening, and thank you to the panelists for bringing your time and expertise to make this a great event for us. And of course, thank you, Rob, for all your hard work in putting together these events. And as Rob said, I'm Jen Stowell, and I'm the founder of Realty School 101, which is a pre-licensed program for California real estate. If anyone here has any interest in getting involved in real estate, or anyone you may know, please let me know and I will help you with the requirements. Also, I've helped place a lot of startups throughout the Bay Area in office space. So location needs are one of my specialties, as well as connections. Of course, I have a lot of connections. So if you need salespeople or you want to get introduced to some engineers or attorneys, I know quite a few in the Bay Area. So please use me as your resource and ask me any questions you may have. Thank you.
All right, next up we have City National Bank and Pramal. So let's hear it for City National Bank.
Hello, everybody. My name is Pramal Sangani. I'm from City National right in Palo Alto. I'm the relationship manager, kind of have my own book of business, manage clients like VCs and entrepreneurs. If anybody here that needs a bank or is looking for deposit or lending, you can always come and see me. If you have any questions, come and see me after the event too. Thank you. Nice.
So though our local mission is to support entrepreneurs here in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. To that end, we have a robust YouTube channel, and we're rolling out some of our videos to other platforms. And our partner in this endeavor is Tim Jeggers of Jeggers Films, one of the top professional videographers in Silicon Valley. So let's hear it for Tim.
Thank you, everybody. Thank you, Rob. So I'm Tim. I've been doing Rob's events for several years now. I've been doing video production for about a decade on top of that. I cover events like this. I shoot weddings on the weekend. I do explainer videos, interviews, product demos, bio pieces, sizzle reels, all kinds of stuff. I've got a pretty diverse portfolio after doing this for as long as I have. And if you have any questions about me or what I do or where to find this content or any other relative content to this, feel free to reach out. I'll be around all night. And yeah, thanks for having us.
Yeah, I was here, entrepreneurs trying to tell me what they do. So yeah, a few of them could use some explainer videos. Anyway, here's the schedule for the rest of the evening, ladies and gentlemen. So we're gonna have I'm gonna pass it off to our moderator. We're gonna have a great panel discussion, which is gonna be insightful, dynamic, entertaining, and just downright awesome, right? Then audience members, hold your questions until 8 p.m. At 8 p.m., we're going to open it up to audience Q&A. We'd like to have you form a line and use the lectern and the microphones, and that'll take us all the way to 8:30 p.m. We'll end the formal program at that point. We have a raffle. We've got some great prizes, and after the raffle, we're going to roll out the cake in honor of our 10th anniversary. It's vanilla cheesecake, and we've got some Haagen-Dazs ice cream. So you can stick around, network, socialize, and connect. As a courtesy to Wilmer Hale, we would like to leave the building by 9 p.m. However, there is an after party. Talk to me, and maybe you'll be invited to the after party. So with that, I'm going to pass it off to our moderator. He's just one of the top corporate and startup attorneys in Silicon Valley. And he's your partner here.
Thank you, Rob.
He's a partner in this firm.
I am a partner, yeah.
Okay.
Last time I checked.
Okay, I wasn't sure. Most importantly, though, he is passionate about helping entrepreneurs succeed. So let's give it up for Todd Rumberger.
Thanks everybody for coming out tonight, and thank you, Rob, for having us here again. So tonight we're gonna both do a look back on 2019 and hopefully not spend too much time on 2019 and hit 2020. I think with 49 or 50 minutes, we have a lot of ideas of things to go through. I suspect that we're probably not going to hit everything, but we will do our best to get through, hopefully, and make this an interesting program. I think maybe just to get things rolling, getting a sense for who the audience is probably always a good idea. So I'm going to run through really quickly kind of a grab bag of different things that people do and why you might be here. Maybe just raise your hand, and we'll get a sense for who our crowd is. So let's start off with founders. Who is a founder of a company? All right, and with traction. Great.
So questions keep getting harder.
Yeah, even better. Okay, employee of a startup. Okay. How about any government folks out here? No. All right.
One person.
Academics. Okay. All right. Look at that. Investors. Okay. Very good. How about journalists, bloggers, writers, marketers? No? All right. How about somebody with just an idea for a startup? So exploring on your off time.
Couple.
Okay. And then just there's people who just love to come to these things, so they don't really have any good reason to be here.
All of us.
All right, excellent. Well, I think the next thing we're going to do is have the panelists actually introduce themselves, because again, we got 45 minutes probably left here, and we're going to try to do our best to maximize time. So I will hand it off.
Okay. Hi, everybody. My name is Darwin Ling. I'm the general partner and founder of Good AI Capital. Good AI Capital, we are a venture fund. We invest in early stage AI companies in the area of fintech, healthcare, and enterprise software, or B2B SaaS, software as a services. So we are mission-driven thesis. So we call ourselves the Good AI Capital. The good part really stems from the fact that if you start by doing good, you end up doing really well. So because of that, we partner with entrepreneurs and technologists that have a deep desire to tackle some of the most challenging problems faced across industries. And because of that, you can see why we have a very specific focus on those three areas. So prior to that, I was an entrepreneur and technologist. I have a CTO for a startup focusing on AI, using AI for sales productivity. We have customers that include General Electric, Home Depot, and Danaher, which is a medical device company, Fortune 500 company. And also I was an angel investor in several startups. One of the company that you might be heard of is I was an early investor of a company called SoFi when they're Series A. It's a fintech company. It's a student loan company. I invest in the company when they're Series A. The valuation is $100 million. Now the current company is worth $5 billion company in this latest round.
How much did you invest?
Good enough to start my own fund.
Yeah.
Do you have a suite at the new stadium?
Should we go first?
Yes,
Or?
absolutely.
Okay.
Hi everyone, my name is Vidya Raman. I am with Sorenson Ventures, early stage venture capital fund based out of Sand Hill Road. Prior to joining Sorenson Ventures, I'd been an operator specifically in enterprise product management for a really long time. Sorenson Ventures in particular, we invest in enterprise startups, seed up to Series A. We also have a private equity fund. It's a separate fund, Sorenson Capital, based out of Salt Lake City. It's a $1 billion fund. In terms of Sorenson Ventures focus, we are focusing on enterprise software, basically. We have several investments in cybersecurity, infrastructure, and also a few AI ML-enabled applications. My background, most immediately prior to Sorenson Ventures, I was Director of Product Management for AI and Machine Learning Platform at Cloudera. And prior to that, I've worked at a bunch of different startups in the Bay Area, many of which, of course, don't exist anymore, and a few that continue and thrive but are in different homes. In general, I have a background in enterprise software, machine learning, AI, and IoT. very happy to meet with female founders in particular, even if we don't invest. One of the reasons I moved to venture is to be able to find an avenue to make a difference here. Thank you.
Okay. Well, it's very difficult to follow Vidya. I've been in tech for 23 years. My name is Nuno, and I won't say the rest of the name because it's quite complex. I am originally an engineer. I wasn't a 10x guy, so I became an engineering manager and a product manager. My passion is product management. Sillily enough, I haven't really spent my full-time working in product management for a long time, so again, a bit envious of Vidya. Then I became an operator. I had my first entrepreneurial experience in a company with friends. Never do a company with friends. It was actually awesome. We broke even, but then friends. Still friends with them, shockingly enough. And then went to become a growth operator, so really around strategy, corporate development, business development roles. By that stage, I had lived both in Europe and in Asia Pacific. I'd worked in over 35 countries, and so it was a wonderful life story. And then I did two silly things. I decided to move to the Bay Area and work in the Americas as well. And I did the biggest, silliest thing that I've done in my life, which is I decided to become an entrepreneur again in venture capital. So I'm a managing partner and founder of a fund called Strive Capital. And we mostly focus on consumer software as a service. We invest in companies that you might have heard about, Anish, which IPO'd in Tokyo Stock Exchange, KeepSafe, App Annie, Gusto, Rubrik, and a few others. So relatively fast-growing, either consumer or software as a service companies. All joking aside, I feel very blessed because not only I'm a venture capitalist, but I'm actually a VC times 2. I also do a little bit of a leg at Grishin Robotics, which is also on Sand Hill Road, that is more focused on the hardware side of the things. There we invest in companies like Zipline, Ring that sold to Amazon, Eero that also sold to Amazon. All our smart home portfolio sold to Amazon. I don't know if there's a pattern there. And a couple of other companies you might have heard about, like Spin that sold to Ford as well. So very, very blessed to be in venture and authentically blessed to be in venture.
Thank you, Rob, for inviting me. My name is Sanjit Singh. I'm the chairman and co-founder of UFirst Capital. UFirst Capital it's an outsourced CVC, corporate venture arm, for several corporations. We have been signing almost at the rate of one corporation a month. Some of the notable corporations that you may have heard about are Dow DuPont or others like Hyperloop, MasterCard, etc. Before that, I was at Intel Capital, focused primarily on enterprise software investments. And with UFirst Capital, we also have an early stage fund investing in seed, post-seed, pre-series A companies, mostly B2B, I would say, enterprise and IoT sectors. I have been, I would say, on the lucky side of venture capital, having gotten one exit every year. My 2020 exit also just happened a week ago. A company called Orb Intelligence that we invested in from UFirst Capital got acquired by Dun & Bradstreet. It's a B2B marketing company. 2019 was Pinterest going IPO. 2018 was Cloudera 2018 was DocuSign going IPO. 2017 was Amazon, again the acquisitive company. Amazon acquiring a company called Body Labs. But I always try to ask myself what's missing. So instead of getting carried away with exits. So that's my background. Been in the Valley for 20 years. Still a core technical geek at heart. In my spare time, I've been building some NLP algorithms as well for data extraction. My rule for myself is to automate everything I do in my daily life by end of this year.
All right, thank you. Thanks, everybody. So let's dive in. Nuno, best investment.
It's like asking a parent what's the favorite baby or child. I mean, I have a lot of investments that I've loved. Even some companies that in the end didn't go, incredibly well, that we had Hail Marys in terms of exits, that the company was almost failing and somehow we managed to get an exit in. They're all very special to me. I mentioned some of the ones that I'm particularly proud in terms of their path and their growth, like Gusto, Rubrik, App Annie are obviously like pretty stellar enterprise software companies. I mean, some of the fastest growing enterprise software companies of all time. But I actually wouldn't name just one. I do care deeply about entrepreneurs, and it's a bit strange to be an investor after having been an operator and being an entrepreneur myself in venture capital, because you have to empathize with entrepreneurs, but at the same time you also have to be the tough parent as well and make difficult decisions. And so the way I found to figure that out and work on that over the years, and it was very organic, was a very silly thing. I started getting a lot of startups that I wasn't investing in that said, we'd like to work with you somehow. And I did a little bit of advisory, but I didn't like that. I used to be a consultant. I was a partner at McKinsey & Company. And I was like, that's not very interesting. So what I found is I actually like to work with entrepreneurs separately. So I became a coach, and I've worked with a bunch of really incredible entrepreneurs, some of which that I had invested in the past, that I was not even on their board of directors anymore, that asked me to be their coach consultant, because I'm not really coach. And mentor has been bastardized, so I'm the type of guy who doesn't ask a lot of questions. I'll get assertive pretty quickly, so I had to call it coach consulting. But basically that's what I love about being an investor and being very blessed, because I get to see at least 750, 1,000 companies a year. In terms of pitches, calls, etc. And it's a very personal business, right? This is your business. You guys, when you start, this is your blood, sweat, and tears. So for me, I can't name one. I'm always very proud of the companies I invested in. I'm also very proud of the companies I can coach. And sometimes I even get very proud about companies I passed on, like Snapchat, which I passed before their Series Seed back in 2012. I'm very, very, very passionate about that, about the notion that you can make something that's nothing emerge into something that's really gigantic. And sometimes the biggest success stories are not the $5 billion IPOs, not the 50, 100x returns to investors. Sometimes the biggest success stories are the ones where you're like, it almost died, it almost died, it almost died, it almost died, and then something happened, and there was a decent exit for everyone involved. And it may have not been the best return of the fund, but still everyone's happy. And in some ways, I'm not trying to be all, fun here, because we all want to make returns and we all want to be in the top 5 percentile. But actually, it does matter what happens to the entrepreneur, to the company.
Sanjit, I'm going to hit you with, I don't know if it's a hard or an easy one. Mm-hmm. Worst investment.
I made an investment in a hybrid cloud company way back, and the team was very solid, came out of Microsoft and other corporations, and good initial technical team. We knew we still have to make a business out of it. And they started getting good early customers also. And Netflix started using their hybrid cloud. Even Apple started using their hybrid cloud solution. So everybody was pretty happy. A lot of venture money went into that company. I don't want to give the name of the company, but over time, and it took us probably a couple of years to realize this, early customers are very important, less from a revenue standpoint, but more from a resonating effect standpoint. Are they helping you build a use case that you can replicate in the market? And what we learned with this company was the early customers, especially with the likes of Netflix and Apple, they have such unique data center architectures and the needs that those use cases are not easy to replicate in the market. They're very unique companies, and that's why they are successful. Kudos to them. But from a startup standpoint, when you're selling to companies like these as your first customers, you feel happy with the brand names of the customers, which is awesome, but you forget that the use case that these guys are using me for is not replicable beyond these companies. And that's what happened. Over time, what we realized is, if you look at Netflix, we couldn't get Hulu, etc., other online video streaming companies to use this product. Same thing with Apple. We couldn't get the use case that Apple was using this company, but we couldn't get other companies to use this product for. And eventually the company had to pivot. There was CEO change, there was a lot of team change, etc., which is kind of predicted in a VC funded company. But the core problem could never be solved. And the second lesson, besides the first use case lesson, the second lesson I learned from that company was every startup has a finite time window to find customers. Because you typically raise funding, let's say you raise a $3 million seed round. You have 1 year before you're typically going to raise Series A. Now you raise Series A, a $10 million Series A, you have 18 months to show traction for Series B metrics, and so on. So a startup's life cycle runs in these time windows. And if you cannot, as a CEO, or collectively with investors as a team, if you cannot show traction within that time frame, you have a hard time raising money, outside or internally with the current investors. So because of that, market timing becomes more important than anything else in a startup's life. So if your market timing is too off, either you're too early or you're too late to the game, you're not going to be able to get traction. So that was a company where I think pretty much all the investors lost money. And you know, you can put the blame on investors, you can put the blame on CEO, but it's collective vision of everybody for taking that blame.
Yeah, I remember, I don't know if it's still going on, but there was something that used to go on up in the city called FailCon. I don't know if anybody ever attended that, but literally, like, I mean, they would have hundreds of people show up, and the whole would be over a day or maybe even 2 days. It was literally about companies failing.
Yeah.
And then the lessons learned.
But more companies fail than succeed in Silicon. That's why Silicon Valley is successful.
Right. You better
so
learn.
Failure is you should wear it on
large
the,
conference
as a badge.
Yeah.
Right? People are too afraid of talking about failures. Yeah. Nobody's perfect. And if in venture game you're not failing, that means you're not taking enough risk. So you're not going to get that one big hit either.
Yeah.
Both of these things go together.
That's why lawyers are picks and shovels.
Yeah.
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 There you go.
Yeah.
Okay, so let's move into 2019. Let's do a quick look back. I'm just going to go down the line and give one sector that kind of stood out for you as a particularly kind of hot sector. Darwin.
Okay. So one thing I didn't mention, so when we invest in healthcare, one of the key thing that we're looking at is this idea called precision medicine. So this idea is really tailoring the therapeutic solutions, whether it's liquid biopsy for cancer treatment or gene therapy delivery, as well as taking personalized diagnostic via medical imaging using AI. I think AI is a buzzword in the last 5 years, but I think we're taking shape in the last year or so in 2019. So we're seeing a lot of emerging, really technology that come to life, that's AI drug development, medical imaging, and all that. So in 2019, we're seeing a lot of great results going in, and 2020 is going to be greater.
All right. I like your optimism. We agreed ahead of time. We're going to keep optimistic about 2020. Vidya.
Yeah, so in 2019, one of the things I was a little bit surprised about was the number of new companies that were still getting funded to in the AI ML tooling space, despite the number of tools and technologies that are out there, especially in the open source space. That was one of the things that I wasn't quite expecting, and I guess the trend still continues to some extent. But one of the things that I do think is promising, and we started seeing some steam behind this, especially with the recent acquisition of XNOR by Apple, is that tooling to be able to do AI machine learning at a small scale, what some people call tiny ML, is one area that I found to be making a lot of advancement, and that's an area that requires a major attention, especially with things like autonomous driving, really trying to break out into mainstream.
So I'll unbundle this. There's obviously hot, and then I'll talk a little bit about why hot is not always great. In fintech, I think it's a mess, and it's still very hot. There's a lot of bundling and unbundling, and it's very unclear if it's unbundling that's going to win or bundling that's going to win. Is it going to be very segmented approaches to fintech, where I'm serving very specific parts of the market, like students that have student loans, etc., small and medium businesses, etc., or is it going to be the rebundling of it for end users, where I have very unique views of my portfolio of activities, investment, savings account, etc. Certainly, it's an area that needs to be disrupted. I'm not sure. I mean, we've seen obviously SoFi and a few other companies that have done incredibly well. I'm not sure. I think certainly the jury's still out on what's the key trend and what's going to happen. Maybe it's a space that's a little bit overheated. Around the hardware and physical tech space, as I said, with my role at Grishin Robotics, it's very clear that it's becoming hot again. I think the cost curves of hardware are not quite at the same level of the software space yet, but at the same time, clearly we're seeing great reductions in the development of products there, which is great news for us, in particular investors, because we start seeing proofs of concept earlier on, launches earlier on, and that's what we want to see, not very capital intensive, $5 million, $10 million plays that have not launched. Actually, I saw one the other day, I won't say who it was, amazing product. They haven't launched yet. They've raised $100 million, and they're raising again. $100 million. I mean, so I think those cost curves are going to be really, really interesting and really beneficial. And for me, the hot piece of that space is the fact that everyone's now thinking about recurring revenues. Because guess what? If you're doing a hardware play and you're selling hardware only, nothing else, you're going to be valued around 1x your revenues. There's no magic here, right? GoPro went public, 1x, right? I mean, everyone gets valued at that. So at some point in time, you need to figure out what's the other perspective of this. Is it software? Is it services layer on top, etc.? So we saw a lot of interesting things last year that I think are really showing us what the future is going to look like around physical tech. And thirdly, there's been some really hot things around consumer, in particular around digitally native brands, people that are selling the new brand of olive oil directly to consumers, etc. It's super, super, super hot. I'll come back to that later, because I think hot sometimes is the wrong place to invest if you're a venture capital firm. Sometimes looking at the stuff that's either not very sexy or that actually has gone through hot like 2 or 3 years ago and it's now plummeting might be a good time. I mean, if we looked at it, maybe AR, VR is a good time to start looking at it again. This was a joke, by the way. But at the end of the day, I think that's what we as VCs need to be. There's a lot of lemming mentality in VC. And I don't think that's always good, like, okay, someone is going to invest in the next prefab company for construction tech. There's going to be, 10 funds investing in prefab. I don't think that's always good, and sometimes we just totally miss it. AR, VR, again, was a good example of that. I think we didn't, as an industry, see the fact that we first had to have platforms, we first had to have devices, we first had to have networks before we had anything else. Right? And so with very low attach rates, we started investing in companies that focus on development of games for VR or whatever, which doesn't make any sense because nobody has VR headsets out there. So in some ways, these were the hot areas that I saw. I would say out of the three, I'd say probably fintech is the one I believe in the most, although I think the things we've seen are not the things that are going to make it big. The other ones are probably a little bit too overheated for me, but that's what for me was hot in 2019.
AI has been touched upon, and AI as a keyword has been hot in 2019, and I actually really hope that it dies in 2020.
Yes.
Because it's just a buzzword and it has caused too much confusion in the market.
And then you'll invest in 2021, 2022.
Yeah. Startups are pitching. Every startup is an AI company. It's like baseline nowadays, so you shouldn't even have to invest in AI as a category anymore. It's every startup is implementing or using AI to some extent. So AI has already been talked about. I want to talk about something about open source. If you look at the data center stack, a lot of the innovation up and down the stack over the years, last 15, 20 years, was driven actually by open source technology. And then there were startups built leveraging that open source or creating their own developer ecosystem based on their open source algorithms. And I actually, personally speaking, feel sad that open source has lost its charm from a business model standpoint in the last 2 or 3 years, because of which we have seen a decline in the number of open source startups in 2019. And it's not good from an overall data center innovation standpoint. And it's also not good from a developer ecosystem standpoint, because a lot of the platforms that we use are thriving because of the whole developer base that has come up around each of those platforms. So that is something I hope improves and gets better as a trend in 2020. And you do need bold entrepreneurs to create open source companies because of the business model challenge, especially initially, before you can start charging for, hey, here are the add-ons, or here are the services revenues, etc. But that's an industry level problem, and it's not just a problem specific to startups. I think it's a problem that is affecting even mid-size companies. I mean, Cloudera, Vidya worked at Cloudera, you've seen the consolidation. You look at the Hadoop space, there used to be Cloudera, Hortonworks, MapR. MapR went south. Hortonworks and Cloudera had to come together. And even then, you don't know whether that's going to survive long term, right? And Hadoop is just one example. But there are other companies, other sectors, open source based sectors that have very similar problems. So I actually feel there is need for a new business model innovation in the open source ecosystem, and that's my hope for 2020.
Thanks. Okay, without any commentary, tell me sort of the hottest startup that kind of jumps to your mind and the worst startup that jumps to your mind for 2019. I'm going to go down the line. No commentary. Just name the company.
Okay, I go first.
Name the 2 companies. Okay, Darwin headed.
Theranos.
Okay, what about the best company, hottest company that got your attention in 2019? I want both.
Well, okay, it's actually in my portfolio company. It's called Mykonos. It's doing gene therapy delivery payload for microfluidics and solving CRISPR and potentially have a $1 billion business.
Okay.
I'll go with Theranos too. No
Okay.
an argument on that, since the documentary book is out.
Yeah,
Know the most
sure.
about it. Best one I've seen so far, Psycognito, one of our portfolio companies in the cybersecurity space.
Okay.
You guys are going to see this pattern, right? The best is obviously in our portfolio as well. The hell
Best,
yeah. So best rubric. So let's get that out of the way. I wouldn't say worse, but I think rework has taught us all a thing or two. So yeah, no commentary.
They're on the street, right? The office.
The best company I came across in 2019 is a company called Merits.com, and I always look at companies, and I feel that the best companies are the ones that are not obvious. Merit.com is a company that is digitizing certificates for firefighters, etc., all of that labor force, and they are ushering in a whole new digitization era that is never talked about. Nobody goes after that, and they're selling to governments, that again a sector that a lot of startups shy away from. So I have high hopes from that company. Worst company is all the SoftBank funded companies, I would say. You can pick.
No commentary.
No commentary, but you can pick whether it's the W company or whether it is the
T company.
You pick any, they're all same.
Fair enough. All right. So we're gonna next turn into hit 2020. So again, let's try to keep it to a few minutes. We got 20 minutes left, but I think we're doing actually pretty good on timing. So let's talk about what you're seeing in 2020 so far, and prognosticate out. What do you think is going to be the place that's going to take off, or really be the best place to put your chips down?
So I'm going to go micro, not macro. The macro stuff is just very depressing right now, to be honest. In the middle of potentially a pandemic, we'll see, and a couple of other things. So on the micro stuff, I've spent most of my time working around consumer. A lot of people don't like consumer because it's difficult. I love consumer. and some of my best investments have been in the consumer space. I think there's something dramatic going to happen in 2020 around consumer startups, but it's not what people think. I think it's not just a classic direct-to-consumer 2.0 digitally native brand that I was talking about earlier, the next marketplace, etc. I think there's something that's more profound. And if you look at it, it makes sense. We have two big generational shifts happening, right? One, which is Gen Z. I mean, Gen Zers are very different from millennials, and they'll consume things differently. They have different expectations. Millennials were the first digitally first generation, but Gen Zers are the first mobile first generation. That changes the game. So I think there's a lot of exciting stuff happening there, and I think the stack might actually not look anything like we know it today in 5 to 10 years. So maybe the world domination of Facebook won't be so evident, and a few other things I think will happen in that stack. So very excited about that. And then at the other end, very obviously the senior citizens and what's happening. And if you look at it, there's also a lot of interesting shifts. Some of these seniors are actually tech educated, and if not, their children are. And children, as we know, are in many cases the customers to a lot of these services. They're the people that set up a lot of these services. So I think there's two spaces around consumer that I'm super excited about, both in software and in hardware, just to be clear. The second sector that I would go, and I will go just very, very quickly around that, is VC itself. And I'm a proponent that VC needs to be disrupted once and for all in some ways. And not for the reasons you think. I think VC as an asset class makes a lot of sense. But if you look at where the value is created in venture capital, it's created in what I call the picking stage, which is deal sourcing, due diligence, deal making. And if you look at a lot of the noise you've heard from a lot of the big VC firms now, some of them relatively recent VC firms in Silicon Valley, they're all focused in the post-investment space. They're focused on shared services, market development, talent acquisition, all these things that are great, but we know in VC that that's not where most of the money is created, right? If you're a great VC firm, you can help your company maybe pull off a 2x exit instead of dying, or a 4x exit instead of a 2x or something like that, but it's definitely not 0 to 100x. That's in picking, right? And that's what guys like Benchmark have taught us and a few others have taught us. But if you look at it, the part around deal sourcing, due diligence, and deal making hasn't been innovated on in a very, very long time. Everyone plays by the same playbook. You know, thought leadership, networks of influence. I hire another associate that has access to another network of influence, and that's great. You know, speaking at events like this, like we're doing all these things, everyone plays by the same playbook. And guess who wins, right? The guy who gets the best brand wins, because obviously inbound comes to them. Sequoia, Benchmark, all these guys. So I think it's time to actually disrupt that. We did that at a very tiny scale with our first fund at Strive, and so my next fund, which I'm working on right now at Strive, is really going to focus on that. How do we fundamentally innovate around that space, and how do we become more fact-based, more analytically driven? So it's not AI, it's actually how do we have analytics engines that help us generate more deal flow and help us in basically doing more due diligence. So I'm very, very bullish on those two things.
I beg to disagree on some of the comments. Can I comment?
No, please.
Yeah. I actually pretty disagree with a lot of things you said. If you look at the VC equation, it's a dollar plus value equation, where dollars are number two, value is number one. And your point about that VCs should spend more time and energy on picking rather than on the value add is actually the opposite of what I think.
Yes.
I feel that if VCs spend enough time, actually feel they should spend more time, if they spend enough time on company building, market development, helping their portfolio companies, then better deals will come to them automatically. Because founders, your current founders will refer their founder friends, and hence VCs would become better pickers as well. They would pick better deals also.
Yeah, I've noticed
it's a cycle. So the fact that you say, hey, VCs have stopped or started focusing less on picking.
That's not what I said. They haven't innovated. They haven't innovated on the picking side.
Because they are innovating on the market development side, and that's what they should focus on.
And we disagree.
Yeah, we can agree to disagree.
No. I agree. I agree with you on the fact. I agree with you just to get the option here and there as well. I agree on the fact that VCs, in 99% of the cases, actually rarely create value for their portfolio companies because they're either cheerleaders on the board or they're actually screwing the companies up, right? And I think we as VCs have an obligation to make sure that the company is as successful as it can be, but also towards the entrepreneurs that put in all the hard effort to get there. And as a notion to that, as I said earlier, I'm a coach to many of these guys, right? Coach, right? So it's not just I'm an investor. In some cases, I'm a coach. So I agree with everything you said there. The only point I'm making is if you have a lot of assets under management and you can hire 100 and something people to do shared services for your portfolio companies, that I don't believe will create as much value as spending the little assets under management you might have to actually focus on the picking stage. That's what I'm disagreeing
But
with.
if you do that, the latter part, then you cannot add value.
You can. Why can't you? Because I still have time. If I have more time, if I spend less time doing due diligence, if I can have a team, by the way, 95% of all venture capital firms in Silicon Valley have less than 10 people.
Yeah.
Right? So basically, if I have an ability to do due diligence with less resources in a much more time efficient way, right, I have more time to spend time with my portfolio companies. So there's nothing wrong about that. I'm just saying I want to innovate on the beginning of the stack, right? That's what I'm saying. And nobody really has, right? We have very few examples. We talk about Signal Fire, Tribe, it used to be Social Capital, a few guys who have done a little bit of quant and analytically driven. Very few people have innovated on that.
Yeah. We can go on.
Yeah,
I can give a rebuttal to the rebuttal.
let's keep moving here.
Yeah.
Okay, Vidya.
Okay, I think we can all agree on everyone having good intent and want to innovate. So the two areas that I want to touch upon is one on, so both related to AI and machine learning, one on the tooling side and the other and the application side. So from the tooling side of things, I do agree with Sanjit that I actually think that things will start dying down in the following manner. I think there will be a consolidation that's going to happen imminently. It's already happening in some cases in the tooling side of things. And I think in order for more companies to be able to realize value from AI and machine learning, we'll start seeing more and more innovation happening around the data infrastructure side of things. So think, building data pipelines, data engineering, a lot of mundane things that haven't been getting that much attention from a lot of top VCs. And then on the other side, again, like Sanjit pointed out, saying that a startup or an idea is AI, ML based blah, that's like saying my software is a SaaS product. Yes, of course, in 2020, that's kind of the basic expectation. So I think we are getting beyond that. And also, when you factor in the case that, it only takes less than a dozen people to get a bunch of AI and ML tools rigged together with data to build an app, I think what we are going to want to invest in should require more deep domain expertise. So think non-glamorous industries where AI and machine learning can make a lot of impact, especially when you think of applying AI and machine learning at the edge. That can fundamentally disrupt a number of business processes as we have seen it for decades now. Like, think of how much of backhauling data you can avoid, how much you can save from data center costs and things like that. So on the application side, what I'm really excited about is the potential for innovation in domains that haven't been considered attractive. And also coupled with the fact that you bring in edge computing and being able to do AI and machine learning at a small scale, I think that will make a huge difference.
All right. Okay. So as I listen, I want to respond to every single one of you. So now let me just kind of step by step going through. So one thing, the first question you asked, that lady said, what's my check size? I didn't get a chance to respond. So we do seed Series A and Series B and even Series C. So we tend to have a small number of portfolio, but we have a high conviction strategy that work with founders closely. We start with their seed, and we can start with a $300,000 check to $4 million to Series C. So with that, I want to respond to Nuno's response about the VC industry. It might work for some of the seed stage, early stage company pre-A, but once you go beyond that, it's hard to say what's my value add, and that's why you kind of maybe that leads you to say, you know what, that's it, you're on your own. We've done our work, you're up to the hands of Sequoia to put more money in, or what So it's a little bit different from us because, we take that high conviction strategy where, we work with the founders. I'm a founder before. I care about the founders' success. And that's why we kind of crafted this strategy where, we add value because, we care about the values and the mission of the company. And that's why we intentionally invest in some of these industry that we want to focus on. So one thing I want to respond is regarding sort of the SaaS industry. So one thing I didn't hear the part is, so there's an emerging area called robotic process automation, RPA. So this is actually one of the hottest area that is coming out. So for those who are not familiar with RPA, it's a software bots that try to automate a lot of corporate tasks such as within your HR, payroll, finance, and all that mundane stuff that you see a banker trying to cut and paste. So basically, they are using tools that actually automate those processes. In fact, one of the hottest couple companies that you didn't hear much about, actually they got like tons of money from a VC fund start with a soft and something end with something. So you know who that is. So this guy got like $1 billion valuation. Basically, that's exactly the point behind it. There is the automating this in different tasks within industry, in manufacturing, in insurance, financial industries, because it touches on every single corporate functions, and that's why they're receiving a lot of this attention. And one more thing is that the opportunity of AI. So the AI, one of the issue is AI is that people talk about, just using the name AI for the sake of AI. So that's why I got tired of it. So one thing that we care about is that the data, and then also the opportunity where you can actually, the more you use, the more data you supply, the better AI outcome or prediction that can actually generate. So in this case, the RPA, where it's actually trying to automate different people's tasks, mundane, but actually, as the people are as if you're writing your own script to kind of automate the first kind of like version of that script. But as people starting to use it, maybe, the minutes that you spend of clicking this and all that, kind of just create this, essentially the data, what we call a flywheel, effect, where the more you use it, you create more data, and you actually generate better, AI model to do a better job. So this is actually what get excited and get attract a lot of funding for a lot of these big funding behind it. And that's actually has an impact towards all different industries. So actually that's why we're so excited about this. And finally, I want to talk about the opportunity for fintech. So we obviously, I'm an investor in that little company called SoFi. Yes, they've gone through some hard time, but actually right now, this is actually going through this unbundling process where I think this is a great opportunity. And we see that actually that are taking place right now. We just see the acquisition of Plaid, PLAID is an API fintech company. They basically empower all your Venmo transactions and all the banking and all that. They got acquired by Visa for $4.3 billion. And because of that, I'm extremely excited about the fintech landscape for 2020. And Stripe is going IPO this year. So as part of this, actually, you might just know Stripe as a JavaScript company that actually enable the merchant payment on the internet. But actually, they do much more than that. When they enable that transaction, there's a piece of AI that is taking place. Basically, they're doing credit scoring. When you try to enable your transaction for your credit card, so basically, fraud detection, or even the KYC, anti-money laundering, everything is going to. So that's actually where, instead of trying to look for it, it's going to be another fintech company becoming another bank and all that. We're looking at all these different functional opportunities where a lot of these companies can, take a lot of advantage and actually thrive in the new, 2020. So with that, I think, fintech it's going to be, we have to coin the word. So Andreessen called the word, software eats the world. And actually, I'm saying fintech's going to eat the world in 2020.
All right. So anybody have a concern over a correction this year? Or do you think this has got pushed out now to 2021 past the election? Because that, at least in my past, those sort of early concerns. I can remember a couple years ago, Sequoia came out and said, and it was sort of ripped around the valley, like, we're not doing any more Series A deals, and then sure enough, people started doing deals again. And right now, from at least our perspective, I think we're seeing business as usual. Is the music going to stop in 2020?
Probably not in 2020, given that it's election year and till now the results look good. But I do believe the music will stop. Maybe 2021, I can't predict, but it's not gonna keep going up. But there is another trend that we haven't talked about as a group. Is I feel till now we have only talked about data is a new oil, or everybody has talked about that for years. Data is a new oil, and the value is in data. You need data to drive AI. All of that is well understood. I actually feel we are entering into an era where data is a new venom for companies. You need data, but it's also going to eat your company. Look at what happened with Facebook in 2019. So the privacy laws are getting very strict. The responsibility around data is getting to be very, very strict. So you need data to drive your company forward, but that data will also end up eating your company over time. So we will probably start to see in 2020 an era of responsible data companies. Not even talking about ethical data companies, I'm talking of responsible data companies, and hence a trend, and this from a venture capital standpoint, that actually will start creating an opportunity for VCs to invest in that band of companies that will drive results with the data responsibility. And I actually feel that there is room for a new business model around data. Whether you pay back to consumers, which I don't think is very likely, or you drive a new business model with brands that utilize your data, all of our data, etc. So that whole layer is going to evolve. Till now we have talked about there is data and there is algorithms, whether it's AI or or big data algorithms. Data drives these algorithms, but in between there is going to be a new responsible data layer that will come up in 2020.
Okay. Nuno, last, because I want to get through everybody, last remarks. Nuno.
Last remarks in general?
Last, just in general, in terms of what's your prediction? Is it business as usual for the rest of 2020? Should people be quickly trying to raise money before it all goes to hell?
I'm not sure it will be in 2020 or not.
Down?
The readjustment, we've had a really poor start of the year. We're not even at the end of January. And there's macro stuff. It might be that it's 2021. I do agree with Sanjit. We do agree.
All right.
We're
friends again.
We're friends again. I do agree with Sanjit that I think this has to stop. We've been in a bull market for such a long time. I'm not sure it's going to be this year or next. I have no clue. I think for me, the nexus of what's going to happen this year is going to be the relationship between the U.S. and China, and in particular what's happening in China. And as I said, it's been a really poor start for China this year, very unfortunately. So I'm a little bit more bearish now on day 30 of the month than I was on day 1 around that. But certainly it will have to stop at some point.
Vidya.
So I slightly disagree with the fact that things might be business as usual, especially in certain domains. It does seem to me that there are certain areas where, even having been in this job for a month and a half, I've seen like at least a dozen ideas which are pretty much around the same, slightly better aspect of, okay, we can do this, life cycle of AI machine learning, or maybe a problem in sales and marketing automation, which we can improve with AI and ML. It does seem to me that there is a proliferation of companies in certain spaces. So my prediction is, if you're an undifferentiated business, then I would, start honing in on what is the angle that you should differentiate on before avenues for funding close out.
Darwin?
Yes. So I share the emotion that Nuno mentioned. I add to that, I'm actually from Hong Kong. So originally, we have gone through a lot of unrest in the last year. And with the whole coronavirus that is taking place, I'm worried every day. But at the same time, we are seeing great opportunity, especially in the healthcare We have an opportunity to innovate using AI technologies. So there are certain things that are on the macro level that I could not control, but I focus on what I can do best in terms of I put more of my resources into technical resources, capability, network, anything that I could. At the end, if I can make an impact, I think this is something what we should focus on. I cannot control who's going to be the next president of 2020. I hope something good outcome will come out, but we should just focus on what you're good at. As a startup founders, this is what my message to you guys. Keep doing what you are at. I think being a founder is tough. You just need to stick with it, and this is don't chase the best idea or whatever idea that some VC firm tell you to work on and all that. Have the genuine conviction of what you do. I think this is something that what really matters.
All right. So I think it's Q&A time.
Yeah. First, let's hear it for the panel. So we want to take as many questions as possible. I'd like to have people come up, line up. First of all, I want to mention that this is not a pitch event, so please no pitches or thinly disguised pitches. And if someone comes up here and attempts a pitch or thinly disguised pitch, we have a bouncer in the room to deal with it. Jen? So be forewarned. So anyways, who's got a question for the panel? Come on down. Go for it. Julie.
Thank you. Hi. Thanks so much for the talk. And I want to pick up on a theme that Nuno, is that correct? Nuno started. Nuno. Yeah. Okay, then Nuno started. Some great discussion about sectors, which sectors are hot, which ones are heated, which ones are overheated. But Nuno was I think, really brought out a unique point of view, which is that the entire field of how we approach this investment category is also potentially a competitive advantage or an area for disruption or change. And I'm curious if you think that is likely to happen a little, a lot, and if so, in what ways? And I'll just add one other piece to that. So like at the fundamental challenge is there's more and more folks coming into the market is there's only so many unicorns that can be chased, and which would tend to perhaps push to different models that can find ways to make a profitable component of your portfolio be not just unicorns. And that would open up opportunities for a lot of other types of businesses and entrepreneurs. Is that something you see?
I take it also a little bit as a discussion between small ball versus long ball, where you're trying to go for things that are 5x returns, 10x returns, instead of all billion-dollar returns. Is that a bit the question? Are there different theses where I can fit in the market and go for different types of companies that might still be great returns for me as an investor, but not necessarily always aiming for the fences? Is that okay? I think you started having that already. And you have some funds in Silicon Valley that do that really well, that have gone after not obvious things, and they have long-term, high-commitment positions in companies that go beyond even one fund. I'm not sure we're seeing a great deal of disruption on that. I think the orthodoxy is still that you're going to have 2 or 3 companies in your fund that are going to return the whole fund or plus, and so you have to make big risks. I don't believe in that. I'm not going to argue with Sanjit anymore because he's going to beat me up again. So I'm not going to argue what's best or not, but I believe that certainly at the top of the funnel, when you're trying to think about constructing your portfolio, you should play a little bit of small ball. You should be very, very thesis driven. But again, people here on this panel will be like, well, if you're very thesis driven, you won't hit the 100Xs, right? Because you'll miss the Ubers and the Airbnbs and the whatever at very early stage. And my set of beliefs is that you should actually reserve a part of your fund, a small part of your fund, let's say 10, 15% of your fund, to do those bets, right? And that's actually where the team can shine, where the team can make the calls, and you don't need everyone to be unanimously at the table. And everyone will tell you these stories where the biggest arguments at partner meetings normally are the highest returns of the fund, right? So I do think there's space for that. I don't think there are many funds doing that. Just so that I don't look like a madman at this table that is saying things that the orthodoxy in Silicon Valley is not thinking about. I won't say the name of the fund, but one of the truly tier 1 funds in Silicon Valley, I know for a fact that every time they're having a portfolio discussion, they'll take away their top 3 investments out of the discussion, and they'll just focus on the rest. And they'll say, can this return 5 to 10x? and they'll have significant discussions on that, and they'll spend significant resources on that. And you do have, and that's one thing I will absolutely agree with Sanjit, at some point you will absolutely have to be all hands on deck to make the company successful. And if that means introductions to 150 funds for their next round of investment because they're having trouble raising, if that means you, out of your hat, figure out a way to do an exit for the company, that's part of your job. By the way, I've done all of these and I'm very proud of it. I just feel that there are very, very, very few firms thinking like that, certainly top of funnel, when they're looking about top of funnel, deal sourcing, etc. So I don't think that will be get significantly disrupted by the mainstream funds in Silicon Valley.
Good answer.
Hi, my name is Umida. I'm founder of Global Clean Tech Impact Expo. I'm just working on to launch to give a support for clean tech innovation, but I'm gonna hijack your conversation because for me, AI, machine learning, very important in our lives, but it's becoming more boring. So my question to you is, when do you start to discuss about the importance of investing in clean technology and climate solutions? We have to see that among all investors in the Silicon Valley, because that's where is the money is, there where is the innovation is. We have to drive, make these entrepreneurs to build the companies. It's when discussing clean tech, it's not just the energy, it's not just the electric car, it's everything from clean water to materials to reinventing the even eco-friendly solutions for every product that exists on the market. So that's my question to you.
So take that.
There was a time when VCs invested a lot in clean tech.
One in particular.
One in particular starts with a K, and then actually two firms. Both of them start with K.
With K, yeah.
Where Kleiner Perkins and Khosla Ventures.
Yes.
Kleiner Perkins, from what I have heard, lost a lot of money in clean tech, and I think this was in 2000. I don't know, 5 to 8, 9 time frame. It was roughly that time frame, and Khosla Ventures did okay. And after that, clean tech as a sector just died in VC's minds. Now, that doesn't mean there is no good opportunity in clean tech. I actually do believe there are good opportunities in clean tech. It's just that it's hard to find follow-on funding, hard to drive the company forward, etc. Having said that, there are companies that are getting funded around climate change, for example. I was trying to recall the name of the company, I'm forgetting, but it's a portfolio company of Ignition Partners. They have invested in a company that can take all these data, publicly available data from cities, etc., and can predict, hey, there is potentially a hurricane coming, or we see signals for earthquake, whatever, right? So that's what they are trying to do. So there are companies trying to solve some of the environmental challenges also. And there are actually some dedicated funds. It's unfortunate that a lot of those funds don't get visibility in the market or press, but there are funds focused on clean water, for example, water issues, for example, or other such issues. And there are the second type of funds that do invest in those companies are the social impact funds. Now, they also have to make money while investing in social impact companies. The job is actually harder for them, but they do invest in some of those companies. Double Bottom Line Partners is one. Mitch Kapoor runs a fund, Kapoor Capital. There are quite a few such funds as well.
I would just like to make a comment. I agree with everything Sanjit said. I think there's social impact funds. There's a lot of things happening with people really trying to fuel innovation in that space, from Bill and Melinda Gates Foundation to Emerson Collective and a bunch of others. I actually think the tipping over point here for climate change and for all the innovations around that is going to come from corporations. And it's going to come from corporations. And where I'm getting optimistic right now, it's going to come from corporations that are being pressured by their institutional investors. BlackRock has just come out. Larry's been talking about this for a long time. State Street Advisors, which probably people in this room have never heard about, they only have 3.2 trillion, I think, under management, so not a lot. Has also come out saying we are going to demand that the companies we invest in have a significant agenda and a tangible agenda that they're measuring their impact on climate change. And I think that's where the real innovation is going to come from. Because when that happens, and when these guys stop putting money to oil companies, et cetera, if they're still doing oil, et cetera, everyone's going to step back. So in this case, I'm not sure venture capital is going to be the right dynamo to this. And I'm not sure we have a lot of time either, actually, to be honest. I think it's the corporations that probably will push that. And then at some point, policy, et cetera, will catch up, which needs to catch up, right? Because there's a lot of stuff that's going on that is not okay. I'm not, in this case, bullish about VC changing the world, because there was an incredible, the guy who made me want to be a VC, John Doerr, I mean, incredible, right? Who made a huge bet on this. And unfortunately, it wasn't the right bet for that specific fund or for that specific line of their business.
I want to add something, because I worked for a company that was funded by one of those Silver Spring Networks, that was funded by Kleiner and Foundation. And luckily, in the IPO, it just broke even. But what I want to say is, so my perspective is that some of those technologies you said, like AI and machine learning, which, maybe are different somehow and don't have a material impact, I actually think that that's not the case. I think that this industry and the financial returns that were not possible back in the day would actually become possible potentially with technologies such as AI, machine learning, 5G, and edge computing coming together. And the reason for this is that, I was part of this group of, incredible engineers who were pioneering a lot of things which, we were doing with big data and machine learning and AI. And we were throwing it on the other side of the wall to these utilities that had people, whose average age was 55, 60, close to retirement, barely college educated. And they just didn't know what to do with all of that. I just think that, so the technology there is definitely going to make a difference, but it's not quite there today. So I think there will be a time when, companies like PG&E and, all these other utilities, they will be able to make better decisions for us as consumers and be able to provide us all more cleaner and greener energy. And technology is going to play a huge role in making those investments, more worthwhile for VCs. I'm more hopeful here about that.
Can I just chime in real quick here? So I think this is our thesis, Good AI Capital. This is actually what we want to do to provide doing good to the world. So I think it is, I agree with Sanjit mentioning the whole social impact is going to be a little bit difficult, but actually we find a way where, we can actually do good and actually make money at the same time. So this is actually what our thesis are. So kind of the way that I want to respond, say, when you try to look at the climate change, what are the things that you can do? Nuno mentioned that you can actually have an opportunity to say, from the corporate world, the Blackstone, the Microsoft of the world. And we are seeing that actually right now there's a company where they're still actually selling basically a battery, basically a fermionic, battery will actually absorb the heat during the generation of carbon, the heat, and then actually turn that into utility electricity as part of that power plant. So we're seeing material sciences, material engineering that are being developed and applied. They're not really, trying to change the world in a global scale, but they're actually doing something towards the corporate. Another idea I want to give it to you, actually, we have looked at a company. What they do, they have a ESG mandate. ESG is really standing for the social impact. So the idea is that actually they sell their, basically it's a hedge fund tool where basically look at the water consumption, any like climate related materials or any waste generated. So they sell it to the hedge fund manager. When they decide to want to invest in a company, they actually want to utilize these tools to say, now that I have a mandate, if these guys are actually having that, they violate certain ESG index or metrics that they follow on, they will not invest money in that company, for example, because of their investor driving them to say you need to have kind of that mandate. So these guys are using satellite data, water data around. So basically, using all that environment to provide that, basically it's a dashboard that allows you to look, you should not invest in this oil company because they are right next to this and using something that actually causing issue for the environment. So that actually a potential way where actually you're gonna make a lot of money, selling the hedge fund guys, and then and you having an impact towards the world. That's all I'm trying to say.
I mean, it seems to me too that the institutional LPs, right, the pension funds also could make decisions on where they're pushing the money, and
Sure.
they could have a mandate and say, look, we're going to insist that this certain category is invested in.
Yeah, totally.
Yeah.
Yeah.
So I have one more suggestion. I could sit with you for a coffee individually and convince you
question.
that. So, but one thing I would like to see is it has to be an obligation.
Bouncer.
Can you not interrupt me? I would like to see that it has to be an obligation of every investor in the Silicon Valley to discuss the importance of the climate and climate solutions. Whether you are investing in it, you're not investing in it, because that industry needs to really push from the Silicon Valley.
Yes.
That's what I would like to see, and I would love to invite you to my
We've got 3 more questions. Give them a chance. Go ahead. Vote use electric, please.
I wanted to thank the panel. I think it was very informative discussion, and I took a few very good nuggets for me. I'm a first-time founder. My name is Vishal Goenka. The question that I had was actually inspired by a comment that Nuno made about Gen Z in the consumer space. What I'd love to understand is how do you, we understand that Gen Z is kind of born with mobile phones in their hands very early on. And so the way they use mobile and the way they use computing is very different than pretty much everyone else. But how do you extrapolate that, or how do you take that, and apply to a lot of the different consumer tech and sort of understand how that generation is going to change sort of consumer tech in a significant way? Any thoughts?
So without giving you the keys to the kingdom, the thesis and how you build thesis, just to give you one idea, right, that one would necessarily do. You look at the existing taxonomy that addresses millennials, Gen Xers, etc., social networks, marketplaces, the specific vertical marketplaces. You'd look at content development and content provisioning. You look at all the different taxonomic pieces of it, and you'd see, okay, how do these behaviors that Gen Zers have that are fundamentally different from the previous generations, how would they change, how they would be addressed, right? So that's how you'd build thesis over time, very top down. At the end of the day, in VC I always say this, and some people get this the wrong way. We're not in the business of predicting the future. We're not in the business of predicting the future, right? So actually figuring out momentum sometimes matters more than predicting the future. I predict the future sometimes, and I got the investment wrong, right? And I was spot on strategically. It's what's going to happen, but I just invest in the wrong company, right? So in some ways, we then need to glue that in with the team we see in front of us, and with the market that they're specifically going after, and with the product that they're trying to do, and with the competencies that they have, and with the technology stack that they have when they show up in front of us. And so it's a little bit of a mix of those two things. And I'm really simplifying this whole discussion, but it's sort of this top-down view of the world. And then when we have the team in front of us, I'll be like, okay, I was just talking with you, Darwin, about a deal that was like a party round that I had yesterday. And a party round is like everyone's going in, and you have to come in or you're out. And I was supposed to have a call with this founder and he's based on the East Coast. I was supposed to have a call with the founder at 3 p.m. or 4 p.m. Pacific yesterday. And he sends me an email in the morning. He's like, I have a ticking bomb term sheet, which means he has a deadline on it that expires at 3 p.m. Pacific. So I need to see if you're in or not. Okay? And at that time, you have to just make the call. You have to look at it. It's like, I'd met the company before. They haven't launched yet. I mean, they're raising, I won't say the amount, but they're raising a Series Seed. So this is their second round. And it's silly. And these are Gen Zers, and they have something special. And I almost invested. Just to be clear, I almost invested, right?
The founders were Gen Zers, you mean?
They are Gen Zers, and they're going after Gen Z, right? And they might be onto something. They might be the next equivalent to Snapchat. Who the hell knows, right? Some people believe they are. So again, I think it's sort of that mix of, once there are people in front of you, you need to make the call, even if, it's like directionally, I know it's going to be different. Instagram, I'm not sure Instagram is going to serve Gen Zers in quite the way that it served millennials. Snapchat might have a shot, who knows? But TikTok clearly is something special, and what's happening there is very special. We'll see what happens on regulation there because of this whole U.S.-China thing going on. But there's just to give you a very specific example around communication or social networks that come from communication. I think that's, for example, an area that I spend a lot of time on and try to figure out what's the next big thing. Again, we're not in the business of knowing the future. We're just in the business of figuring out there's market momentum and this company might have a shot at it. That's basically it.
Thank you.
Hi guys, thank you. It was very, very helpful. I too am a first-time founder. My question really relates to building on your earlier topic of themes, and I know you can't exactly see the future, but you may have a good sense of where the momentum is going. And given it is a US kind of election cycle this year, are there any interesting kind of upcoming themes in the AI space, specifically within the kind of news, media, print, TMT space?
Fake news has been talked about so much that it's almost fake to talk about it now. I'm actually more a fan of, nothing to do with election years, but I'm more a fan of verticalized AI solutions. And this goes back to the basics of building a startup. Hey, what problem are you solving? Not start talking about I'm an AI company or a big data company and that's how you solve the problem, but rather what problem you're solving. So start with that. And then start looking at, hey, what solution do I need to build to attack that problem? And over the last 3-4 years, we have seen a commoditization of the infrastructure space to a great extent. And thanks to AWS, etc. And it's great for innovation in general. It's not great for infrastructure startups. And hence, there is more value created by startups that are vertically focused with an app on top. It doesn't have to be a consumer app, it could be an enterprise app as well, but an app on top. So looking at that as a framework for building a startup, then you start looking at what problem am I going to solve. And I really won't look at, this is an election year, so what problem am I going to solve? Election year is going to come and go. I mean, your startup lifetime is much longer. Every founder should think about, hey, I'm building a company that's going to go become the next Facebook rather than building a company for 1 or 2 years and then sell. Best companies are bought, not sold. So if you're building a company for the election year, assuming that, hey, by end of this year, I'm going to sell for $10-20 million, just don't do it because it won't happen likely. So you really have to start thinking of what is the big problem that I'm going to solve. And the other thing that I encourage founders to think about also is stay away from the herd mentality of startups in the Valley. A lot of the startups in the Valley are Me Too, and they're solving incrementally. They have an incrementally better solution versus thinking really outside the box. Like there's a startup that DJ Patel, he was the chief digital officer under President Obama. He's doing a startup now. It's in the healthcare space, or health, I would say document management space overall. You can check it out online. It's going after space. It's a boring space. Nobody goes after that. You start respecting founders who go after uncharted territories. Right? I just caught up with him, and what he talks about, it's like VCs don't even think about it. So you really should be thinking outside the box rather than, hey, here's my election year opportunity.
Thank you.
Hi, my name is Zeki Gunai. I'm the CEO of Kratos Technology. It's a enterprise software company that uses tiny ML techniques to bridge the gap between the digital and the physical world to provide insightful information to RPA tools and enterprise. My question is, Vidya talked about a little bit about the 5G emergence and edge and how 5G is going to go together. I was in a meeting a couple of weeks ago, and there was a lot of discussion about how the lower latency brought on by 5G is going to be eliminating sometimes the on-premise server-based solutions in enterprise, and sometimes the edge processing is going to go away. And being the CEO of a company that does beyond the edge processing in really low-cost hardware and enormously, or exponentially increasing its value, that's basically very relevant to me. So that's my first question. The second question is Sanjit, actually. What is the question? The question is, how will 5G affect the edge computing, or is edge computing going to go away and everything's going to be still done on the cloud? And because there was some heavy comments about how 5G is going to be producing this low latency and high bandwidth communication between end nodes and end devices from the physical world, and edge computing is going to go away. The edge servers or on-premise computing is going to go away. So what is your vision on that one? Does that make sense?
Yeah. So I guess the most commonsensical answer would be that it's not going to be an either or world in the foreseeable future, given the number of cloud-based, centralized applications that there are. It doesn't make sense for everything to move over to the edge, just overnight. But having said that, one also has to wonder, what does it mean to create new applications on the edge or move some of those traditionally centralized applications over to the edge? So for me, it comes down to use cases. What use cases make the most sense to have on the edge versus in a more centralized manner? So for instance, if you are thinking of doing trends across, say, multiple data centers, multiple franchises across different geographies, applications that require collation of data and understanding trends at a macro level, it's almost a no-brainer to think that makes for a good, cloud-based application. Whereas there are some, obviously, which require or which can do well with even data localization. So if you want to, figure out when a certain transformer is going to trip, yes, you could train a model that is, trained on, that you could use a model that is trained on maybe 1 million different transformers, but this specific transformer has certain signatures which will be the most helpful in terms of predicting when it's going to fail. So in that case, it's a clear use case for local edge computing. So I don't think it's going to be an either or. So my point of view on this is going to be it's going to be very use case specific.
I would add one thing. I think there are two important trends that are going to push more to edge computing rather than less. One is data. I mean, Sanjit has already talked about the whole notion of data privacy and what data actually goes out of my network. If there's data being processed, for example, on my video cameras in my home, why does it need to go to the cloud if it can be processed there, right? That makes sense. And the second thing is there's more and more compute at the edge, right? With our little smartphones, etc. So I think we're going to have more edge computing for a while. To your point, I don't think 5G as a latency play that's going to be the big dynamic around cloud. Cloud is very pervasive today. It's going to be very difficult to change some of these architectures overnight. But I do think we'll get more and more edge computing coming of age going forward because of these trends.
Yeah, that's great to hear, because that's the entire thing that I base my company on, right? So edge computing or beyond the edge computing. And I have a question for Sanjit. He basically, or the panel, Sanjit mentioned about these timelines of a startup. I mean, there's limited time. Once the clock starts ticking, you got to do certain things by a certain amount of time. And what clashes with that is the enterprise sales cycle sometimes. As you know, and you can easily appreciate, enterprise sales cycles are very, very long. So what would you advise to the startups who are in enterprise sales, or basically who are selling through enterprise sales process? What would your recommendation be?
That's a very good question and a great insight. Thanks for providing that. VCs that invest in enterprise startups, they understand the enterprise sales cycles. 6 months is nothing. A lot of the time 1 year, sometimes 1.5 years. Yeah. And especially if you're selling to telcos, 2 years plus.
How about oil and gas?
Oil and gas even slower, right? So we all know that. So, but the point I'm trying to make is, the metrics for some of those companies when they're raising Series A or Series B are a little different. So for example, a VC may expect, hey, do you have enough POCs lined up with enterprises? And VCs are also very good at building an enterprise advisory board of CIOs. So they will send your pitch deck, or they'll send you to two of their enterprise CIOs and say, hey, if he or she builds this product, would you actually buy and pay for it? So there are ways to mitigate against that. But as an entrepreneur, speed is the currency for entrepreneurs. That is a problem you have to still solve because the burden is more on your shoulders than on the investor's shoulder. They'll move on to the next pitch.
Yeah. All right, thank you very much.
Thank you.
So kind of linked to the panel, I'll just ask my question real quick. Just wanted to get your take on marketplace investments right now. Are they still hot? Are there any issues?
It's dead.
It's sort of the current kind of environment right now.
I think there's a lot of activity from some very well-known funds with very well-defined theses that you can watch online. I'm not sure if that's their real thesis or if it's their public thesis. Maybe a little bit too hot in some ways because it's a little bit going side by side with digitally native brands. And I don't think all digitally native brands have the right to exist. Certainly not DTC 1.0, right? Certainly not the whole notion of I just innovate on search engine optimization, I innovate on customer acquisition, on marketing and marketing funnel, a little bit on branding and packaging, and that's it. I'm done, right? I do think we'll see the emergence of fundamentally different new digitally native brands, and we'll also see the emergence of marketplaces that are very, very well suited for mobile-first plays. I mean, we have a fight right now going on peer-to-peer with guys like Mercari, Letgo, and a few other big companies right out there, or well-funded companies at least out there that are just competing for it. So I think there's exciting stuff going on, but again, there's a lot of noise. There's a lot of, okay, the next tennis shoe marketplace, I'm not sure that's going to be the thing, right? And we've seen, for example, Nike. The other thing that's happening is you see the big brands that have historically been very, very much away from end consumers like you and I, right? They don't know much about us actually because they sell through retailers and through marketplaces and through Amazon and everything under the sun, coming back and saying, wait a second, I can reclaim the customer ownership, right? Because I have the brand. And Nike has been very clear about it with John Donohue joining them. So I think there's going to be some interesting movements there that will somehow dissipate a lot of these Me Too plays in the marketplace space. But it's certainly hot for investment for sure. Certainly a lot of funds are focusing a lot of their attention around it.
All right, we got time for one last quick question and a quick answer. Kathleen.
Very quick. I want to ask you to predict the future. Something that I hope that AI can never do. Who will win on Sunday? Todd.
49ers, come on.
Come on.
49ers. Yeah, that's not even a discussion.
Niners?
Yeah.
All right.
For everybody who doesn't know, her father's Carmen policy.
Oh, wow. Can I just make one final plug? Rob, you're not going to kill me. I did want to say, Vidya, that I saw your LinkedIn profile, and one of the things that I found very inspiring, we didn't talk about diversity, we didn't have time today, but one of the things I found very inspiring is that on Vidya's profile on LinkedIn, she explicitly states that if you're a female founder, you reach out to her and you'll get a meeting. And I think that's not only impressive, as everyone who's a female founder in this room should take advantage of it.
Thanks for mentioning that.
All right, once again, let's hear it for the panel. Let's hear it for our great moderator, Todd Rumberger. Ladies and gentlemen, stay in your seats. It's the moment you've been all waiting for, the raffle. Jen. So has everyone who wanted to enter the raffle already done so?
Oh wow, a lot of books.
Yeah. All right, Kamal. Your prize.
Shake it up.
Check it out. And winner is
Alto.
Hey. 2020's going to be a good year.
So I'll let each one of our panelists get a shot at it. So here are the prizes.
So picking more.
So I think this might be fun. The 5 dysfunctions of a team.
All right.
Okay.
We're looking at it. We're looking at it.
Scott Williams.
Scott, going once, going twice, he left. He must be present to win. That's dysfunctional, at least before the round.
Saeed Ahmad.
Oh, Saeed, right up your alley. Smile for the camera. Do a selfie. So, how about this? Mobilize an Insider's Guide to the Business and Future of Technology. Esti Mawadi, she's a panelist we have every now and then. She's not here tonight, but it's a great book.
Can I go?
Darwin, you're eligible too.
I haven't put my card yet.
I'll give it one offline.
All right, okay. No, it's okay.
And the winner is Rajiv Verma. Rajiv,
No.
come on down. On once, going twice. Rajiv left, must be present to win. Want to do it again?
Oh.
He's not here. Sonia Ahua, Broadcom. Let's move on down the line, okay. Hug your customers.
There you go.
How appropriate. And winner is Rick Murphy, PhD, Sequoia Robotics. Rick Murphy. Going once, going twice. Rick's not here. No hugs.
Or he doesn't want a book. I mean, he might not want a hug.
Douche, wow. Come on down.
There he is.
Perfect timing.
All right.
Yeah, hug your customers. I'll skip the hug though. Well, yeah, I'll do a handshake.
Wait, what about the speech? Accepted speech.
All right, so here's Steve Jobs by Walter Isaacson. You know.
Kai Edwards.
Last thing, the best round.
Yeah.
I'll do your raffle next. All right, so now it's time for the cake. Josh.
Oh, wow. Is this like going to be a proper happy birthday thing?
Looks like.
We're going to set off the smoke alarm.
Yes.
Just blow it out quick.
Can I have a happy birthday?
Happy birthday to you. Happy birthday to you. Happy birthday, dear Idea to IPO. Not Rob. It's not Rob. Happy birthday to you.
All right, come get your cake and ice cream.
Nice.
Very good. Thank you.
Let's give a big round of applause for the audience.
Yeah.
Thank you.